Sally Beauty is a familiar name in shopping centers, known for hair color and beauty supplies. For decades, it's been a go-to destination for both professional stylists and everyday shoppers looking for the latest in beauty trends and products. Recently, Sally Beauty Holdings released its latest financial results, and the stock price dropped over 6%. This sudden dip caught the attention of investors and analysts alike, sparking questions about what triggered such a sharp reaction. Why? Despite reporting better-than-expected earnings, the company's forecast for the next quarter disappointed Wall Street. The numbers looked good for now, but the outlook for the months ahead was less rosy. Investors had to weigh strong current results against a cautious outlook for the future. It's a classic case of good news being overshadowed by uncertainty about what's next. The market's reaction was swift, showing how sensitive stocks are to future expectations, not just past performance. Even a hint of trouble ahead can send shares tumbling, no matter how well a company just performed. It's like getting a good report card, but hearing next semester might be tough. The uncertainty can overshadow the achievements, making everyone nervous about what's coming. The company's own prediction for the next quarter was the warning sign investors focused on. When a company signals caution, the market listens closely. In the next sections, we'll break down what happened, the strong results, the guidance, and why the outlook stole the spotlight. We'll explore how these elements interact to shape investor sentiment. We'll look at the numbers, the CEO's comments, and the market's reaction to get a clearer picture. Understanding these details helps explain why the stock moved the way it did. This story is a perfect example of how investing is about looking forward as much as looking back. Investors are always trying to predict what's next, not just celebrate what's already happened. Even with positive achievements, the future outlook can steal the show. It's a reminder that in the world of stocks, tomorrow's possibilities often matter more than yesterday's results. Let's dive in and see what's really going on with Sally Beauty. There's more to the story than just the headlines. The next scene explains how companies report their results and why it matters, setting the stage for a deeper understanding of the financial world. Every 3 months, public companies like Sally Beauty share their financial performance in an earnings report. Think of it as a company's report card, showing sales, expenses, and profit. Investors and analysts use these reports to judge if a company is healthy and growing. Before the report, analysts make predictions, setting a benchmark for results. If a company beats expectations, the stock often rises. If it misses, the stock can fall. But numbers are only part of the story. Company leaders also explain what drove results and their strategy for the future. This context helps investors understand if a miss is a short-term hiccup or a bigger problem. Both the numbers and the narrative matter for judging a company's future. Next, let's see how Sally Beauty's latest report stacked up. Understanding these basics is key to following the rest of the story. Sally Beauty's first quarter of 2026 brought good news for investors and industry watchers alike, signaling a positive start to the year. The company beat profit expectations, reporting adjusted earnings per share of 48 cents, higher than the 46 cents analysts predicted. This outperformance reflects both operational discipline and a keen focus on cost management. Revenue also edged past forecasts, reaching $943 million, a testament to the company's ability to drive sales even in a challenging retail landscape. Even modest sales growth is a win in today's tough retail environment, where many competitors are struggling to maintain momentum. E-commerce was a highlight. Online sales hit $111 million, now nearly 12% of total sales, showing the company's digital investments are paying off. This shows Sally Beauty is adapting to changing shopping habits, meeting customers where they are, both in-store and online. The company also generated $93 million in cash, paid down $20 million in debt, and bought back $21 million in shares, strengthening its financial position for the future. These moves signal strong financial management and a commitment to creating value for shareholders. Beating profit estimates, growing online sales, and smart cash use painted a picture of a company off to a strong start, with momentum building across key areas. But as we'll see, the market wanted more than just a good quarter. Investors were looking for signs of sustained growth and future potential. The next scene explains why future guidance matters so much, especially in a rapidly evolving industry. Let's look at what changed the mood and what investors are watching for next. After reporting results, companies often give earnings guidance, a forecast for future sales and profits. Think of it as a financial weather report. Investors care more about what's coming than what's already happened. Strong guidance can boost a stock. Weak guidance can send it tumbling. Analysts compare their own forecasts to the company's guidance. If the company's outlook is lower than expected, it raises red flags. Guidance is often scrutinized even more than past results because it shapes expectations. In Sally Beauty's case, the story turned on its cautious forecast for the next quarter. The guidance became the bridge between a strong past and an uncertain future. When expectations aren't met, the market quickly reevaluates. That's why even great results can't always save a stock from falling. The optimism from Sally Beauty's strong first quarter faded fast when the company shared its Q2 guidance. Management predicted earnings per share of 39 to 42 cents, below the 45 cents analysts expected. This gap signaled caution, suggesting management saw challenges ahead. Revenue guidance was also lower than hoped, adding to concerns. For investors, lower profit forecasts are a red flag. Even if it's just a forecast, perception drives stock prices. The company's message: "We expect to do a little worse than you thought." Investors reacted by selling shares, pushing the stock down. The cautious outlook overshadowed the strong start to the year. In the market, expectations are everything. Next, we'll see why good news can still lead to a stock drop. Why would a stock fall after good news? It seems backwards, right? You'd expect positive headlines to send shares soaring, not tumbling. But the stock market doesn't always react the way you might think. That's because the market is always looking ahead, trying to predict what's coming next, rather than focusing on what's already happened. A stock's price reflects future expectations, not just current results. Investors are constantly asking, what does this mean for tomorrow? Imagine your favorite team wins a game but their star player gets injured. Suddenly, the future looks less certain. The win feels less exciting if you're worried about what's next. That's what happened with Sally Beauty. Q1 was a win, but Q2 guidance was the injury report. The company beat expectations for the current quarter, but warned that the next one might not be as strong. Investors had already expected a strong quarter, so the real surprise was the weaker outlook. The market had already priced in the good news, but wasn't ready for the bad. Stock prices react to surprises, not confirmations. It's the unexpected twists that move the market most. Meeting expectations rarely moves the needle. Missing or beating them does. The difference between what was expected and what actually happens is what matters. The negative surprise about Q2 outweighed the positive Q1 results. Even a great performance can be overshadowed by a gloomy forecast. Investors recalibrated their expectations, and the stock dropped. They adjusted their positions to reflect the new reality. In investing, what's next matters more than what just happened. The future always takes center stage in the market's mind. This lesson is crucial for anyone watching the market. Understanding how expectations drive prices can help you make smarter decisions. Let's hear what the CEO had to say about the company's direction. Leadership's comments can sometimes change the entire outlook. Sometimes, leadership's words can shift the narrative. The story isn't over. Investors are always listening for the next clue about the future. CEO Denise Plunges put a positive spin on the first quarter, calling it a strong start to 2026. She highlighted solid sales, profit growth, and expanding gross margins, key signs of a healthy business. Plunges emphasized that fundamentals remain strong, even if the short-term forecast is cautious. Her message: focus on the company's long-term strategy, not just the next quarter. Interestingly, Sally Beauty raised the low end of its full-year profit forecast, signaling confidence for the rest of the year. The CEO's job is to balance short-term challenges with long-term optimism. Investors were urged not to lose sight of the bigger picture, but the market's focus remained on the near-term outlook. Sally Beauty's story offers key lessons for investors. The market always looks forward. Future guidance can outweigh even the best results. Context matters. A single week forecast doesn't tell the whole story. Sally Beauty raised its full-year outlook, hinting Q2 might just be a temporary dip. A good company can still be a bad short-term investment if expectations aren't met. Don't panic over short-term drops. Look at the company's overall health and long-term prospects. Volatility is normal. Understanding the reasons behind it helps you make smarter decisions. The real skill is reading between the lines, not just reacting to headlines. Next, let's wrap up with the big takeaways for investors. Sally Beauty's recent events are a real-world lesson in how the stock market works. The company delivered a strong first quarter, but the market focused on its cautious Q2 outlook. This dual focus, on both past results and future guidance, is key for investors. Sometimes a great quarter isn't enough if the road ahead looks uncertain. The CEO's comments and full-year forecast suggest the Q2 dip may be temporary. Investing is about balancing today's wins with tomorrow's worries. The market's reaction was to focus on future risks, not past success. For long-term investors, the challenge is to see beyond short-term volatility. Remember, a single-day stock move is just one scene in a much longer story.